the market often reacts and moves lower. But here's a key rule you must follow. Never enter a trade just because price touches a trend line. Always wait for confirmation. And later in this video, I'll show you exactly how to confirm trendline trades properly. Trend lines are not only useful for following the current trend, they can also help you spot when the market may be changing direction. In a downtrend, the trend line is drawn above price. If price breaks above this line, it can be an early signal that the market may be shifting toward an uptrend. In an uptrend, the trend line is drawn below price. If price breaks below it, this may indicate a potential shift toward a downtrend. But keep this in mind. A trendline break alone does not confirm a reversal. You still need additional confirmation before making any trading decision, and we'll cover exactly how to confirm these moves in the next section. Now that you understand what trend lines are and why they matter, let's go over the key rules to draw them properly. These principles will help you stay consistent and avoid common beginner mistakes. To draw a valid trend line, you need at least 2 points of contact. The more times price reacts to it, the stronger it becomes. But keep this in mind. More touches do not guarantee that the trend line will hold in the future. It only shows that price has respected it in the past. A trend line is not an exact level, it's more like a guide. Price will not always react exactly on the line. Sometimes price will reverse before reaching it, sometimes it will break through and come back, and other times it will hover around it before moving away. In this example, price reacted from the general area of the trend line without touching it perfectly, and the same thing happens here. This shows that trend lines represent zones, not precise prices, but you should still draw them and stay consistent in your approach. And here, we finally see a clean reaction. Price pulls back, touches the trend line, gets rejected, and continues moving higher. This is what a textbook trend line reaction looks like. This is one of the biggest mistakes traders make. If the trend line is clear and fits naturally with the market structure, draw it. But if you have to force it, then it's not a valid trend line. Here's an example. The first trend line we drew was incorrect because we ignored an important touch point just to make the line look cleaner. That's what we call forcing a trend line, and it's a common mistake. The correct approach is simple. Identify the true swing highs or swing lows, draw the trend line based on those points, then wait and observe how price reacts. Never adjust your trend line just to make the chart look better. Let the market guide your analysis, not your expectations. One of the most common questions traders ask is, should I draw my trend line using the wicks, the candle bodies, or a mix of both? Here's the simple answer. Use whatever gives you the most consistent touches. Trend lines are not about being perfect. They're about connecting price in a logical and consistent way. Now let's break it down. Here we have a clear downtrend. Now, when we draw the trend line by connecting the maximum number of swing points, we notice something important. In some areas, the line aligns perfectly with the wicks. In other areas, it slightly cuts through a wick to connect with the candle body, and sometimes it connects a mix of both. This is completely normal, and this is exactly what we want. The objective is to connect as many relevant points as possible, not to follow a strict rule. The more touches the trend line has, the more reliable and meaningful it becomes. Now let's focus on the trend line drawn from the swing lows. Just like in the previous example, you'll notice some variation. In some cases, the line aligns with the wick lows. In others, it connects better with the candle bodies. And sometimes, a combination of both gives the most consistent result. This is completely normal. Your goal is to connect as many meaningful points as possible, not to draw a perfectly precise line. Now, let's combine trend lines with candlestick patterns to find high probability trade entries. Look at this chart example. This is the Euro-US dollar on the 5-minute time frame. As you can see, the market starts moving downward, showing that sellers are currently in control. In this type of market, traders often look for potential selling opportunities. Now let's connect the swing highs to see if we can identify a valid trend line. By linking these points, we form a clean downward sloping trend line. Once the trend line is drawn, the next step is to wait for price to retrace back to it and observe the reaction. Here, when price pulls back to the trend line, it reacts strongly and forms a clear bearish pin bar. This kind of rejection suggests that sellers are stepping back in and defending the trendline area. Before considering any trade, it's important to look at the higher time frame. On the 30-minute chart, the market structure is still clearly bearish, which supports the setup we see on the 5-minute chart. When both time frames align, the setup becomes more reliable. Now let's go back to the 5-minute chart. Some traders wait for the confirmation candle to close before entering, placing their stop loss above the trend line or the nearest resistance to manage risk. The target is usually set to achieve at least a 2-to-1 risk-to-reward ratio, depending on the situation. Now look at what happens next. Price continues moving downward and eventually reaches the target. This example shows how combining a trendline pullback, candlestick confirmation, and higher time frame alignment can help you read the market more clearly. Now let's look at another chart example. This is the Australian dollar Japanese yen on the 5-minute time frame. As you can see, the market is moving downward, so we start by connecting the swing highs to draw a trend line. Here, we're able to connect 3 clean points, giving us a well-defined and respected trend line. Since price has already reacted to this trend line multiple times, when it retraces back again, traders begin to watch closely for signs of continuation. Now look at what happens next. When price returns to the trendline, it forms a clear pin bar rejection. Shortly after, a second pin bar appears in the same area. So even if you missed the first signal, the second one offers another confirmation that sellers may still be in control. Now let's check the higher time frame. On the 30-minute chart, the market was previously moving up, but then formed a first top, followed by a second top. This creates a potential double top structure, which can signal weakening bullish momentum and a possible shift to the downside. This higher time frame context supports what we're seeing on the 5-minute chart. Now let's return to the 5-minute time frame. Some traders wait for the pin bar to close before entering, place their stop loss above the trend line or nearby resistance, and aim for a target that offers at least a 2-to-1 risk-to-reward ratio. Now look at what happens next. Price continues moving downward and eventually reaches the target area. The same concept can be applied in an uptrend, and it also works across different time frames, such as the 1-hour, 4-hour, or even the daily chart. It's a flexible approach that helps you understand trend continuation and read market structure more effectively. Now you have something most beginner traders don't. You know where to look, how to draw your levels, and how to wait for confirmation before entering a trade. And that alone can completely change the way you see the market. But this is just the beginning. In the next lesson, we're going to take this even further and show you how to turn all of this into a complete trading approach. So if you're serious about learning how to trade the right way, make sure to like this video, subscribe to the channel, and turn on notifications so you don't miss the next lesson when it drops. Thank you for watching, and I'll see you in the next video.